Hi, everyone. My name is Connor McMahon. I'm the retail advisor with Sterling CRE. I'm based out of the Missoula office, and I'm really excited to be able to be here and chat with you all today. So I'm going to be talking about the retail market, going to be talking about what's happening nationally, and kind of boil that down onto a local level as well. So to start off, I want to talk about the retail capital markets and the space markets. So when I say capital markets, I'm talking about the investment side of the retail world. And the space markets, the businesses, the owners, the occupiers, the people that are leasing and buying space for their business, because they're behaving a little funny right now. And normally we see these two markets more or less behave in some unison. When the space market's doing really well and vacancy is low and lease rates are high, that really kind of fuels the capital market side. It encourages a lot more investment activity. It pushes those prices higher. But interest rates and this really big change we've seen over the last year have kind of dampened the investment side of the retail world a little bit. But the owner-occupier side has remained really strong. So what are we seeing on the investment side? A little bit lower demand right now, those increased borrowing rates, and nationally, we're seeing much higher supply of product. So it'll be interesting to see kind of locally that shakes out here. In the space market side, really high demand still. Businesses are doing well. They want to expand and they want to grow. The supply is really low, especially if you're an occupier looking for space to purchase for your business. Really, really low opportunity there. And the labor market has really been strong. That's kind of added some increased pressure for these retail environment. So in the space market, vacancy is up, but it's up just slightly, and it's still very, very low. So normally we see that 5% is kind of our threshold. As you can see, we're under 3%, so very, very low vacancy. Sales prices are up, 21% increase. We'll get into why we saw that increase. There's some anomalies that happened that really drove that up. Lease rates had a nice, healthy increase, and as we kind of expect, the number of transactions did decrease by 26%. So in our pipeline right now, we have 80,000 square feet locally that is under construction in Bozeman. And to kind of frame what 80,000 square feet looks like in the retail world, for perspective, your average large grocery store can be, up to around 40,000 square feet. A large, hardware store is 100,000 square feet. So that is just not near enough to get us up to kind of that healthy equilibrium vacancy rate. And of that 80,000, we have 80% that is pre-leased. So not a lot of opportunity out there right now for our retailers that are looking to expand and grow. We do have an additional 210,000 square feet that are planning and permitting, but as we know, it takes some time for that product to get to market and to get delivered. So I expect the retail market here locally to remain very tight for a long time. And on the right side of the slide here, I've put a really interesting map of the United States. The numbers on each one of these states are the number of available workers for every 100 job openings. So we have a lot of job openings and not a lot of workers available. So that is just adding to the challenge and adding to the pressure that we're seeing right now in the retail space market. So this is a look at those sales prices. We did see that really big increase in sales. So in blue, that was what we were looking at this time last year. Bozeman, we've been relatively flat. Belgrade, a little increase, and Big Sky, of course, Big Sky, as you would expect. Huge increases. We saw some really, really big sales there. As Ryan mentioned earlier, construction costs, there's a lot of things that cause Big Sky to be really expensive. So if you pull Big Sky out of that, we're really seeing relatively flat sale prices for the last couple years here. And so now to kind of take a look into the capital market, as we mentioned, our sales transactions have dropped. As we all know, the borrowing rates, the lending rates have jumped up to what I call more historically normal levels. We say they're very high right now. I talk about high interest rates all the time, but if you zoom out 30, 40 years, we're kind of in more normal lending conditions. We got to get back to figuring out how do we make these deals pencil and how do we underwrite these type of deals. And interestingly, retail investment sale prices have really remained relatively high, which is surprising. So here's a little chart I put together. As you can see, 3 of these lines, they kind of all behave the same way, and one of these lines is not like the others. So on the bottom, I put, we have the single overnight financing rate, we have the 3-month treasury, and then in gray, the one in the commercial real estate world we really pay attention to, we have the 10-year treasury there. And then in the top, these are cap rates, and this is national average cap rates for quick serve retail. And if you go back to where we were in Q1 of 2019, before COVID and before we started having these crazy markets, we have this really nice 222 basis point spread between where the 10-year treasury is and where our cap rates were. And that is, in my opinion, that is beautiful. That is perfect. We look for this between 200 and 250 basis point spread to really get a nice risk-adjusted rate of return. And then what we've seen is cap rates have really remained relatively flat. And then, of course, the 10-year treasury has increased significantly. We got a little bit of movement out of our cap rates, but not very much. So now we are down to a 158-point spread. So that has really compressed significantly. So a lot of these folks that are looking at their risk-adjusted rate of return on these investments, it's not what it was 3, 4, 5 years ago. So if we were all perfectly rational, logical people, this is what our cap rates should look like. Now in the gray, we have our same 10-year treasury. That's the same line as before. We have our same cap rate line. And then in red, we have what I'm calling fantasy. If we kept that perfect 225-point spread between our cap rates and what the 10-year treasury is doing, the red is kind of what they should have done. And you can see it ends up at 6.57%. And we're not anywhere close to that. We're still seeing a lot of these 5 cap deals in the market. So a pretty big gap between buyers and our sellers currently are. And here's just a little example to see what does that look like in real world numbers? What does that mean? So this is just a made up example. Let's just say you have a fully stabilized STNL single tenant net lease. In this example, it's a grocery store, and we're generating $350,000 of NOI. And the seller's expectations are more nationally in line with what we're seeing, 5.75 cap or 6.1 million. But the buyer's expectation, who's dictated by the cost of money, he wants that good risk-adjusted rate of return, he's about a 7 cap. So what does that mean? That's about 18% difference, which that's not impossible to close that gap. We can get there, but it's still pretty big. And that's why we're seeing a lot of this stagnation, gridlock in the market that we keep hearing about. It's that gap there. And a lot of these markets, for some of these asset types, particularly the single tenant net lease, transaction volumes are down 60%, even up to 80% in some markets. So we still have a pretty big gap there. Well, why does that happen? This is something that I am guilty of. I'm sure most of us in our room here are guilty of. This little thing called a recency bias. If you've ever bought a commercial property, if you've ever made an investment decision, or if you've bought a stock, you're subject to this. And it's essentially just this natural expectation that things are going to be how they recently have been. It's the expectation that things will more or less continue as they've been. And so what has kind of been the recent history in commercial real estate world? Well, it's that cap rates were really compressed and the cost of money was super low. So the bias conclusion is that's the market that we're going to get back to. That's how things are going to return. And the result of that bad decision, you end up overpaying. So I have hard to swallow pills, and it's a little hard to see on the bottom, but it says, just because I bought my property at a 5 cap does not make it a 5 cap. And so I know I'm giving some people a hard time a little bit, but the reality is that real estate is not totally fixed. It's not flat, it's not linear, it's quite volatile. And there's markets when it has wonderful increases and markets where it's not so awesome. So this is the S&P 500 sectors. And this is going back, 40 plus years, looking at how real estate has behaved. And so we can see in good years just how incredible it is, and in downturns, well, it's worse than technology, worse than healthcare, worse than financials. It is a volatile asset type. And of course, on the flip side of that, we get wonderful recovery, better than any other sector, wonderful in expansion, and even pretty great in a slowdown. So why is it that we're still seeing hundreds of this type of product on the market? 3% cap rate. And the market nationally is really, really flush with these types of deals. If you want to spend, a 3.5 cap or a 4 cap property, you don't need to look hard at all. Now, I did totally cherry pick this. I went out looking for these, but they're not hard to find. If you do a LoopNet search or a Crexy search, there's hundreds of these nationally out there. And when speaking with these brokers, and every single one of these, and every single one of them are 10-year terms. They're fixed for the first 5 years. No rent increases, fixed, and then that 10% bump in year 6, which is totally standard for this type of product. And you say, well, why should I buy this? And you hear it all the time as a retail broker. Every single week, you say, well, it's just like buying a bond. We hear all the time that retail product is just like buying a bond. So I think if you're going to compare your real estate to a bond, it's kind of important to understand how the bond market actually works. And I don't want to put everybody to sleep talking about the really exciting bond market, but this is the Bloomberg U.S. aggregate. This is kind of like the index for the U.S. bond market. And as we saw, 2022 was the worst year ever for bonds. Bonds, the value of fixed income runs inverse to the value of interest rates. So as rates go up, the value of that fixed income decreases. So what's kind of the point here? You're showing that retail is volatile. You're showing that if it's like a bond, it was a terrible bond year. I don't know, what's the point here? Well, the point is, I think, as buyers and sellers, they need to go in to be informed and eyes wide open in these decisions, because the reality is there's still a lot of people out there that are buying these retail deals. Not a ton. I mean, the volume's definitely down, but people are still buying them because they understand that retail is a really, really durable asset type. It survived COVID, and didn't just survive, but it thrived and came out doing very well, where our retailers were posting record sales, really, really strong credit tenants, long-term leases. And we're seeing this big 18-month backlog because our owners of our retail assets are not in distress. It's not like the office market where they have debt maturing and they really need to sell these properties because they're going to be in a lot of trouble. It's not that in the retail world. They have good equity in the deal. They're having good rental growth. They have really good, safe credit tenants. So they understand that these are still fundamentally good investments despite all these challenges that were just laid out. So to conclude, it was the worst year for bonds. We're still in this steep yield inversion. We've seen cap rates soften, but just a little bit. So we should see cap rates continue to climb. Hopefully we'll get back to more of that normal basis point spread we see between cap rates and the 10-year treasury. Still that strong gap between buyer and seller expectations, but we saw that start to close. Hopefully we'll see that continue to come together a little bit. Our retail owners are not in distress because our retailers are doing really, really well. They're posting strong sales. They want to hire more people. They want to expand. The debt's not a concern. And overall, it's still a very strong, durable asset type despite all the challenges. So that is it for me for the retail world.